Hello guys, yeah, look where we are. Not on the boardroom, but very similar to the boardroom. We are on one of the meeting rooms. And today I want to talk about inflation. You know, sometimes you're trading euro dollar, pound dollar, USDJPY, or any other currency, even gold, you know, some commodities or some stocks on US. And the data release comes out that the inflation on USA or the inflation in Australia or any other place around the world is growing or is decreasing or is sticky, you know. So that has a massive, very important factor into the Forex market, because remember what I've always say, if you start to question up yourself, why did that move happen? Why did this move happen? Then you're starting to think on the right direction. You're starting to think about fundamentals. You're starting to think about, okay, let me sit down and forget about a little bit of the technicals, because technicals are only for entry points, but what is the bigger picture around the world? What is happening? Why is the money flowing out from US and going on to China? Why is the money going to Europe and not going on to US anymore? Why is the stock market collapsing? It's not because it's breaking supports or resistances, right? There's something more on that. So that's the fundamental, that's the market base, that's with everything started, okay? So today I'm going to teach you a little bit about the CPI, the Consumer Price Index, and what it is on a very quick, I would say quick and easy way to understand, and you can implement that into your trading tomorrow or today, even if you have a CPI release when you're watching this video. So before we start, before we go any further, please like this video and subscribe to the channel. And if you think one of your friends want to know what's inflation as well, just share this video with them, because that's going to help us to grow the channel, and that's going to help your friend as well to you know, understand inflation a little bit better. So let's go to the boardroom. Well, let's go to the board here, and I will explain to you what's inflation. Okay, so majority of the economic calendars, they outline the inflation as CPI. All right, so that's the Consumer Price Index. So I think that's the first thing we should note down, that the CPI is equal to Consumer Price Index. All right. And what is the Consumer Price Index? What's the CPI in a sense, right? It basically measures inflation. It has some ways of measuring inflation, some periods of measuring inflation. We have the CPI year over year. That's going to measure inflation from, let's say, February 2022 to February 2023, so a 12-month period. We have the quarter over quarter. That's going to take the quarter one of 2022 to quarter one 2022 and quarter one 2023. So basically measuring two quarters, exactly quarters, but in different years. We have the month of a month. It's basically from last month to this month. So basically from the month of February to the month of March, inflation rose 0.5%. Okay, that's a big rise, but just so you guys understand, so from last month to this month, we had an inflationary pressure. So basically, products are getting expensive. Some of the, you know, products are getting expensive. Some of the products are maybe not getting expensive, and that's how we're going to know is through this Consumer Price Index. And the Consumer Price Index is basically a basket of goods and services, and that's exactly what it is. So how does the inflation get measured? It's pretty simple. I'm going to try to explain to you on a very broad base. We're not going to go too much in depth, but in the end of this video, you will understand how inflation actually makes the Forex market move. How does the release of the data, you know, 5 seconds before the release, all the spreads gets wide. A lot of people don't want to take the risk. Market makers step back because they do too much uncertainty before the release. Sooner the release kicks in, spread comes out to normal, market moves up, moves down, moves sideways all the way, and that's exactly what you can get. That's exactly what you can trade, the move up or down. All right, so let me take all of this out. I know I don't have the best, how I can call it, the thing, that the razor of the board, but that's fine. Right, so Consumer Price Index. basket of goods. Come on, Luca, it's too complicated now. What's that? So think about, I'm not the best bro in here, okay? So the basket of goods and services, okay? As for services. So basket of goods and services. What it is. So basically a basket is, it's a basket. When you go to the supermarket, you get a basket to put your items. That's exactly the metaphor that we're going to use today. So you go to the supermarket, on that basket you're going to put food, of course. You're going to put some, something different. Maybe you go to a supermarket that you have everything that you can put, like Costco, Costco, you have literally everything you can possibly imagine. You have a TV, you have a car, you can buy a car, and you can buy food, of course. So you can buy anything there. So you go buy food, you go as well and buy some, you pay your rent, of course, okay? That's called the shelter, okay, shelter prices, okay? Food is just everyday food, or you can call that as well out of home food. Okay, so you can call that out of home food basically when you go to have a pizza with your friends, or you go to the pub, or you go to anywhere that is out of your place and you're buying food from that. We call this out of home food, and a lot of more things. Okay, so that's the basket of goods. Basket of goods is basically something that you're going to use. Majority of the people, 98%, 95% of the people use on a daily basis to be able to live, all right, a normal standard. If that price of the food that you bought, the milk, was costing $1 in 2022, and now it's costing $2 in 2025, then we have a rise of pretty much 100% from $1 to $4, to $2, sorry. So we rose $1, and that's 100%. So that price of that certain, niche rose 100%. It doesn't mean that the inflation rose 100%, because then, that would be a little bit too crazy. But that's a basket, remember? It's inside of that basket, so we have a lot of items. So in overall, the CPI show you a median standard deviation of the inflation. Okay, so that's how inflation is calculated. I don't want to go too much into the math, because then we would be going too over. But again, inflation, CPI. CPI, Consumer Price Index. Consumer Price Index is measured by the basket of goods and services. And that basket, we have food, we have out-of-home food, we have rent, shelter prices, home appliances, everything else. You have household expenses, like appliances, mobile phone, if you go travel, tickets, if you have a car, mortgage, everything. That's all of the things that we have to be living into normal society on nowadays, okay? So let me write this, let me take this off, and I'll be back in a second. So I've took it off everything, looks clean now, but let's get to the point. How can you trade the CPI? Well, remember I told you CPI has mainly three types of releases: month over month, quarter over quarter, and year over year. Every time you look at the calendar, you're gonna see CPI, whatever, Europe CPI, and then it's going to be like quarter over quarter, or year over year, or month over month, okay? And then 2025 or 2024, whatever year we are. So that's exactly what we want to trade. But there's a big thing here that you can't forget about. Those types of releases, they can be very, very volatile. So you need to be, I would say, happy with volatility. You need to be all right with that, because sometimes you can suffer big losses, but you can make a lot of money as well from those releases, okay? So let's say at 9 o'clock, that usually the time, so 21, we're gonna have the Europe CPI. Okay, cool. We're gonna have three things on the economic calendar. We're gonna have the previous release, we're gonna have the consensus or the forecast, and the actual, okay? So from this, we have the previous, we get the consensus or forecast, and we get the actual. okay? So let's say the previous release, it's stating there that this is the year over year, okay? So that was 2%, okay? So 2%, it's not bad. It's under the central bank target range. Okay, so 2% inflation, that was the previous. The forecast for this year of 25 is 1.8%. Okay, that's pretty good. Okay, so we reduced 0.2%. That's the forecast. That's not what it is. Okay, that's what everyone in the market is thinking about it's going to be, and then they send it over the opinions to economic calendar industry, like even FinLogics, let's say, or investing.com or forexmarket.com. All of those economic, you know what I'm talking about, economic calendars. If you don't know how to use an economic calendar, I've made a blog you can find on the description, how to use an economic calendar. Okay, it's very easy and right to the point. Okay, so the forecast is 1.8, so that's what everyone on the market is expecting to be. And that doesn't mean that it's going to be the 1.8, and that's exactly where it lies, the trade idea here. So you have to always pay attention. 1.8%, it's pretty much 0.2% less than the previous. So what is the market expecting here? The market is expecting a reduction on inflation, so things to get better. And if the central bank, for somewhat reason, that's a little bit more deep into the topic, if somewhat reason the central bank has been raising rates or have been the higher rates for 2 years already, that's going to be pretty good because they're gonna have to ease the monetary policy, all right? So they're going to have to reduce the rates. They're going to have to start to cut the rates. So because that has been controlled already, the inflation has been controlled. If that doesn't come 1.8% and it comes 2.1% higher than the previous, that's going to be a massive trade opportunity to the long side on euro. Why? Because then the central bank will have to maintain the rates higher for longer. And what does that mean? It's very simple. If the central bank has to maintain rates higher for longer, basically the principal they will be paying for retail clients will be higher. Okay, so people will be looking to long those bonds, those yields outside of Europe, you know, people from US, people from Brazil, people from Australia, New Zealand, they will all try to put the money into Europe because they know that the central bank will have to maintain the rates higher for longer. And if the central bank has to maintain rates higher for longer, that's a very good opportunity to long euro. Okay, because there will be more demand from the euro and there will be less demand from other currencies. Now, if that comes to below 1.8%, well, we have a trade opportunity as well. So if it comes below 1.8%, then we're going to look into short euro. If that comes to be exactly the same, we don't have trade opportunities because that came in exactly the same. Central bank will be, you know, central bank was, let's say, right, and they will be continue to be data dependent. That's what they say. Data dependent meaning that they will be watching the data, you know, CPI, PMI, GDPs, everything, to reduce or to hike or to maintain the monetary policy as it is, depending on the data that comes to them. Okay, so if it comes as expected, no trades. The actual comes in to be 1.5%. Okay, just saying. All right, that's not a real example, please. But just saying that the actual came in to be 1.5%. What should you do here? Put down in the comments. I will wait for you. Put down in the comments now. What should you do here? Remembering, the forecast was 1.8. It came up to be 1.5. And the previous is 2%. So lower than the previous, much lower, so 0.5% lower than the previous. And lower than the forecast, 0.3% lower than the forecast. What would you do? I want to know from you. Put down in the comment. Hopefully you did. stop this, pause the video right now, otherwise you're going to get the answer. But you would look to short the euro. Why? Because basically the central bank will look to this and think, oh wow, that's so good, inflation is not sticky anymore, inflation is decreasing, and all of the rates that we've been raising and higher and keeping higher for longer is now doing effect. So we can reduce slowly, but we can reduce the target, we can reduce the rate to a lower boundary, so then we can so then the population can be more stimulated to spend more and then get back to it on the normal society. Okay, so just another, let's go through this everything again. On the economic calendar you will find the time, the Euro CPI, whatever, and then you have previous, forecast and actual. Previous is what it happened, forecast is what they are expecting, and the actual is the time of the release. So when it gets released, we have three options: lower than the forecast, higher than the forecast, or exactly the same as the forecast. Okay, so let me just note it down. We can have the forecast, we can have higher, lower, or exactly the same. Okay, higher, lower, as for same. Okay, let's leave like that. Higher, lower, and same. If we have a higher than the forecast, meaning the currency will get strong. Okay, so currency equals strong. Okay, lower than the forecast, currency gets weaker. Okay, and then same, so basically no changes from this guy here, we have no change. Okay, so the market continues to be exactly the same. Guys, I hope you could understand. If you have any questions, please put down in the comments, and don't forget to watch those other videos here that come in handy when you wanted to trade when you're wanting to trade those types of releases. Remember, trading data releases is really, really nice, but it requires a little bit of strategic allocation as well as a little bit of risk management, because spreads get wide. Remember what I said 5 seconds before, 30 seconds before. Wait for the release, wait for the confirmation, and then you trade those types of releases. And don't forget, this is not a swing trade strategy, okay? This is just a quick scalp strategy, maybe getting 20 points, 30 points, 100 points. I wouldn't say more than that, but 50 points would be ideally for euro dollar, for instance, or even lower than that. But yeah, be careful, because this is a very powerful strategy, and you can definitely use this on a daily basis or whatever when we have the CPI releases. But yeah, I see you in the next one, and don't forget to like and subscribe to the channel. Thank you so much, guys. See you next. Bye bye.